Have you heard the term amortization with regard to a mortgage or other loan, maybe a car loan, and am not sure what it means? Well, you've come to the right place because I'm Professor Capko and I'm going to make it super easy for you to understand here today. But first, I want to say that I believe something great is going to happen for you today. And now, back to the video. If you're someone who finds math difficult or finance confusing, then go ahead and give this video a thumbs up. That way I'll know that you are out there needing more assistance with videos like this one. In this video, we're going to talk about mortgage amortization, but the same principles would work for any kind of loan that's paid back with regular payments, such as an auto loan, something along those lines. Let's talk about what that means. First of all, amortization, the root word for that is mort, which is the same thing as in mortuary, as in death. In other words, we're killing off the mortgage over time. We're killing off that loan with monthly payments. That's essentially what we're doing, and we're going to see how that works today. In our example, we're going to say that you borrowed $350,000 to purchase a home, and we're going to give it a fixed interest rate of 7% and a term of 30 years. The first step is figuring out how much your regular payment would be. I'm going to use my BA2 Plus calculator to do this. I've done other videos on how to calculate a mortgage payment using this calculator. I linked one of them up here for you to take a look at. Let's go ahead and put in our information. $350,000 is our present value. In other words, that's the amount that was borrowed. Our interest rate is 7% and it is monthly payments, so I'm going to divide that by 12. That's our I over Y. And we have 12 payments a year times 30 years. That's 360 payments. That's our N. We're going to compute our payment, and our payment amount is $2,328.56 if we round it. So that's our regular monthly payment. I'm going to put that in here, $2,328.56. Now, of course, your actual mortgage payment may differ because there's maybe taxes, insurance, private mortgage insurance. There's lots of other things that may go into your payment, but this is for the principal and interest. Now, because it's a fixed rate, this payment is not going to change. So I'm going to carry this down all the way through. The payment's going to be the same. And of course, there would be 30 years of these payments. I'm not going to do all 30 years because you're going to see what's going on here in a moment. Now, our starting balance that was borrowed is $350,000. So I put that there as the balance. For the very first payment, a certain portion is going to go to interest and a certain portion goes to reduce the principal amount of the loan. The way we figure it is we take the balance, which in this case is $350,000 at the beginning, and we're going to multiply it by our interest rate, 0.07, and we're going to divide it by 12 because it's only one payment and it's for 1 month. So the amount of interest we're paying for that first payment is $2,041.60, and I'm going to round it to 67 cents. So of that $2,328.56 payment, $2,041.67 is going to interest. The remainder is going to principal. So we have the payment 2,328.56. I'm going to subtract out the amount that goes to interest. That means only $286.89 goes to reduce the principal. That's a very small amount in the beginning. I'm going to subtract that from the balance. So I just put a negative number and I'm going to add it to 350,000 to get our new principal balance at the end of the first month. So $349,713.11 is our new principal balance. I'm going to multiply that by 7% and divide by 12 to get our new interest payment, $2,039.99. You can see it went down slightly, so a smaller amount goes to interest, only slightly, about less than $2, but that means our amount for principal is going up. So I take the regular payment, which is always the same. I'm going to subtract out the amount that goes to interest, and $288.57 now goes to principal reduction. You're chipping away very, very little at first to the principal. So I'm going to take that $288.57 and subtract it from the $349,713.11 that's left as principal, and that gives me $349,424.54. That's our new principal balance at the end of the second month. Let's do one more month's payment. 0.07 divided by 12. That gives me, again, an interest payment of $2,038.3, and we're going to round it to 3.1. So we're going to take our regular monthly payment, which is always the same, 23328.56, subtract out our interest payment, 2038.31, and that gives us a portion going for principal reduction of $290.25. Take that, and I'm going to subtract that from our prior balance, $349,424.54, and that means our new principal balance is $349,134.29. You can see it takes a while to chip away at this balance that you owe the bank. And it's a very slow process at first, but if you can see each month, the amount that's going toward principal reduction is growing, and the amount toward interest is shrinking because the outstanding balance is getting smaller as we go. We get toward the very end, and at the very end, you will see that we have a balance of $2,315.05. I did this with a mortgage table, and the payment remains the same, $2,328.56. If we have a balance of 2315.05, we've got to multiply it by 0.07 divided by 12, gives us interest of $13.50, and that means the remainder pays off the principal, which zeroes it out. So you see $2,315.05 at the end of that, at the beginning of that last month, and you add the $13.50 interest, you have a balance due of $2,328.55, and we make a payment of $2,328.56. So it's 1 penny off after this whole time period. Basically, it zeroes it out. You would not do this by hand. You can use a computer to do it, or spreadsheet, and it would give you an amortization table like this. So if you borrow money for a car loan or a bank loan, ask them to print out an amortization table for you. They should be happy to do so, and that way you know at every point of the way what your balance is. That's how a mortgage is amortized over the course of 30 years. And as you can see, as you get closer and closer to the end, you get closer and closer to having your principal balance reduced. Hope you found this helpful. If you did, please subscribe to this channel and click the notification bell so you don't ever miss a video. Thank you.